Hey guys, welcome back to another video. In this video, I'm going to be looking at General Electric. As we can see, over the last year, GE is up 58%, so it's outperforming the rest of the market. But actually, if we look at the 5-year chart here, we can see that at the start of 2023, GE was trading at around $60 to $70 per share, somewhere around there. So if you do the calculations and you equate $70 up to what is now about $131, that's a share price increase over the last 12 months, or in the year of 2023, of about almost 100%, which means that in 2023, GE basically outperformed all of the big tech companies. So in this video, I'm just going to look into the reason why that happened. I'm going to look into some of the changes that have been happening in GE that have been positively impacting their business. I'm going to talk about their business model, look at their financial statements, and then lastly, calculate the intrinsic value for the company. So before I get into all of that, I just want to talk a little bit about GE's business model and how it is that they actually make money. So General Electric is a 130-year-old company that operates in the aerospace industry, healthcare industry, power industry, and the renewable energy industry all around the world. The healthcare segment of their business has its own company called GE Healthcare, which broke off from the main company in January 2023. For their main company, the aerospace segment of their business generates the most profit. The renewable energy and power segments of their business are expected to break off from the main company in the future. The aerospace segment of their business designs and manufactures commercial and military aircraft engines and mechanical aircraft systems. These products include fighter jets, bombers, and helicopters. The renewable energy segment of their business builds energy generation products and provides different energy production solutions, including wind energy, solar panel, grid solutions, and energy storage. The power segment of their business focuses on non-renewable energy sources. So these products and services are related to energy production using oil, gas, fossil fuels, diesel, and nuclear power. When the renewable energy and power segments of GE's business break off, they will combine and become their own company called GE Vernova. And GE Vernova is expected to break off from their main company, GE Aerospace, in the second quarter of 2024. And shares of GE Vernova will trade on the New York Stock Exchange under ticker symbol GEV. So now we can get into some of the recent news that came out surrounding GE. Basically, this article is titled GE's Turnaround Playbook Helped Push Shares Up 96% in 2023, outperforming the tech giants in the stock market. They point out right here, nearly 6 years ago, GE CEO Larry Culp inherited a bulky, super inefficient, possibly near bankrupt enterprise. Now, through a lean manufacturing revolution and relentless deleveraging, courtesy of rising profits and well-timed asset sales, the CEO has successfully dismantled what was once one of the world's most renowned conglomerate companies, and in its place succeeded in delivering what will soon be 3 independent, publicly traded names, all featuring investment-grade balance sheets. GE's first spinoff, GE Healthcare, which produces medical imaging equipment and tech devices, went public January 4th, 2023. GE Vernova, which houses the energy portfolio, has a spinoff planned for early in the second quarter that will leave GE Aerospace as a final piece of the old empire. For 2023, GE posted the largest share price appreciation of any U.S. industrial in the stock market, clocking a gain of 95.8%. It outperformed tech giants like Apple, Google, and Microsoft in 2023. So this is definitely one of probably the greatest turnarounds for any company, especially a company as big as GE that's been around for longer than pretty much anyone's been alive, and was originally a conglomerate that was really disorganized, but now has turned into this very organized group of 3 companies that are each publicly traded on the stock market and each producing really good share price returns for their investors. So right here we can see the juice of their financial statements, their income statement. Revenues for the third quarter of 2023 came out to $17.3 billion, and that's up from $14.4 billion, so that's an increase of 20% year over year. And then we can also see right here, net earnings attributable to GE common shareholders increased from $88 million to $258 million. So that's an increase of 193% year over year, which, keep in mind for GE's income statement here, because GE Healthcare actually disseminated from their business in 2023, their business was able to become more efficient, and it's actually a lot more efficient just operating solely focusing on aerospace and energy at the moment, which is why they were able to see this massive increase in profits year over year, clocking in at nearly 200% returns year over year. So that's obviously really impressive for GE, and hopefully they'll be able to continue doing this in the future. And if so, they might present a really good buying opportunity in the market. Right here, we can see their balance sheet. Total assets come out to $156 billion, total liabilities of $126 billion, and total equity of $29 billion, with about $85 billion of retained earnings sitting on their balance sheet. Lastly, their cash flow statement, as we can see right here, for the first 9 months of 2023, their operating cash flow was about $2 billion. And of that, their free cash flow for the third quarter was $1.1 billion after investments in property, plant, and equipment for their manufacturing purposes. And then in their financing activities down here, we can see dividends paid to shareholders of $500 million. And although it doesn't say it here, they actually repurchased $300 million worth of common stock in the third quarter of 2023. So they're prioritizing returning value back to shareholders. They're producing record earnings gains year over year at almost 200%. Their stock price returned almost 100% in 2023, beating out all of the big tech giants, and they have really positive free cash flow after increasing their investments in property, plant, and equipment for the manufacturing of their aerospace products. So all in all, a lot of good news for General Electric. So now we can get into the intrinsic value calculation for GE. I'm using this DCF model here, and I'm using a growth rate of 11%, which I got from their free cash flow metrics for the last 4 years. I typically use 5 years, but I wasn't able to get the free cash flow information for 2018. So this is actually 2019 to 2022. And during that time period, their free cash flow increased from 2.9 billion to 4.5 billion per year. So that's a historic growth rate of 11.35% compounded annually. I'm using a weighted average cost of capital of 4.9% to calculate the discount rate for this DCF model. I got that from this calculator right here. Basically, I calculated using this equation, risk-free return plus their beta value multiplied by the average market return minus the risk-free return to calculate their cost of equity of 11%. Their interest rate on their debt was about almost 5%, so it's pretty high compared to the other companies we've looked at. And as we saw earlier from their balance sheet, most of their balance sheet is made up of debt compared to equity. It's about 80% debt and 20% equity. So with these metrics in mind, you can calculate the weighted average cost of capital by multiplying the equity proportion of their balance sheet by the cost of equity, adding that to the debt proportion multiplied by cost of debt, and then multiplying the debt proportion by the tax shield, 1 minus the tax rate, because debt is a tax write-off. That gives you the weighted average cost of GE's capital at 4.9%, as we see right here. According to their balance sheet right now, if you subtract their debt from their cash, it comes out to about a negative $390 million position. And they also have 1 billion shares outstanding, putting their intrinsic value per share at $100 per share, which means that at the current share price, they are unfortunately not estimated to be trading below intrinsic value per share. You'd probably want to buy them at a bit of a cheaper share price. But that being said, obviously this DCF model is using a lot of assumptions. So I definitely encourage everyone to do your own due diligence, because if you use different metrics here, for example, different growth rate metrics or different weighted average cost of capital, or if they continue to buy back shares or issue more shares, then that could obviously change this intrinsic value estimation here. So right here, I did a industry analysis comparing GE to 2 of their main competitors. Given that GE is primarily an aerospace company now, and that Vernova is going to be disseminating in the future, we can see right here, I'm comparing them to Lockheed Martin and Boeing. Compared to those 2 companies, it looks like GE has the better gross profit margin and net profit margin. It looks like Lockheed Martin has the better return on assets and return on equity, but also keep in mind that GE has a lower debt to equity ratio of 0.77, whereas Lockheed has a much higher debt to equity ratio. And if you have a higher debt to equity ratio, your return on equity is obviously going to be higher. So given that they have different debt to equity ratios, it's difficult to really calculate which one is actually getting a better return on their equity. Then we can also see for the dividend payout here, it looks like for General Electric, for every $100 you invest into GE, you're basically getting 25 cents per year, which is obviously pretty abysmal compared to Lockheed Martin at $2.68 per year. That's a lot better. So if you want to base this on dividends and return on assets and equity, you'd probably want to give it to Lockheed Martin. But if you want to base it on profit margins, it looks like GE is the best company here. Boeing isn't even really in the running because they're not profitable and they actually stopped paying a dividend, which is a pretty bad sign for a company. Lastly, we can see GE compared to other companies I've looked at in past YouTube videos on this channel. In terms of intrinsic value compared to share price, as we saw, GE was not trading below their intrinsic value per share. These are the top 10 companies we've looked at so far that were trading below their intrinsic value per share. Then right here, we can see for growth rate, GE had a calculated growth rate of around, I believe, a little over 10%, which isn't good enough to get them onto the growth rate table here. For dividend yield, GE's dividend yield was pretty low. Intel had the highest at 5%. We can see that for profitability ratios, although GE was more profitable than the other two competitors we looked at in their industry, they are not more profitable than the companies we've looked at here. Adobe had the highest at 86%, and Oxy had the highest out of any company we've looked at 36%. However, for Q3 year-over-year revenue and earnings growth, we can see that GE comes in at first place compared to any company we've looked at so far, with a year-over-year revenue growth of 20% and earnings growth of 193%, completely blowing out the previous first placeholder, Oracle, at 60%. We can see from the second quarter tables here that General Electric was actually on the second quarter table as well, with an 18% year-over-year second quarter revenue growth and a 98% year-over-year second quarter earnings growth. So it looks like GE is really on a roll right now. Definitely a company to keep my eye on. I might actually end up investing in this company because based on this, it looks like GE is actually consistently outperforming a lot of the other companies in the market at the moment. Obviously, not just through their financial statements, but also through their stock price. So it might be a good idea for me to invest in GE at the moment, but I'll probably have to do a little bit more research. And then lastly, right here, we can see from stock performance, over the last 5 years, GE has returned 134%. So really, they've only been going on a roll very recently, which does make sense because it's only been recently that they've been making such a big turnaround because of their CEO, Larry Culp. But based on this, over the last 5 years, they're definitely not good enough to get onto the top 10 table here. Tesla had the highest over the last 5 years at an 850% return for their shareholders. So let me know in the comment section down below what you guys think of General Electric. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.